Most people think investing is a skill issue. They assume if you're smart, you win. If you're dumb, you lose. But if that were true, the stock market would be a lot more predictable than it actually is. Because in reality, the market has a strange habit of rewarding the exact behavior that looks wrong at the exact time it stops working. Let me show you what I mean. Meet someone like Dave. Dave isn't an idiot. He reads finance Twitter. He watches YouTube breakdowns. He knows about interest rates, inflation, earnings, all of it. And for a while, Dave does everything correctly. He buys solid companies, he avoids hype, he checks valuations, he feels responsible. And then something annoying happens. His portfolio barely moves. Meanwhile, someone else, let's call him Mike, is buying random momentum stocks, crypto rallies, or high volatility names, and somehow keeps outperforming. Dave starts asking the obvious question, what am I missing? Here's what Dave doesn't understand. Markets don't reward correctness in real time. They reward exposure to risk until they don't. And this is where things get interesting. Because what looks like smart investing and dumb investing is often just different levels of hidden risk. Let's talk about something called beta, not the complicated version, the simple idea. Beta is basically how violently a stock moves compared to the market. High beta stocks rise faster in good times, fall harder in bad times. Low beta stocks move slower, feel boring, feel safe. Now here's the trap. In a long bull market, high beta doesn't feel risky. It feels like genius because every dip gets bought, every bad idea gets bailed out, every random trade works eventually. So people start confusing, I took risk with, I'm good at this. This is where the illusion begins. Because during these periods, the worst strategies often look like the best strategies. Not because they're correct, but because the environment is forgiving. And this is not new. In fact, it's one of the oldest patterns in markets. There have been periods where a small group of companies dominate everything. People stop asking, is this expensive? They start asking, why wouldn't I just own this forever? And that mindset spreads until it becomes dangerous. Because when everyone is confident, nobody is really managing risk anymore. They're just managing regret. Nobody wants to be the person who sold early. Nobody wants to miss the next big move. Nobody wants to look too conservative. So slowly, portfolios shift. More leverage, more concentration, more confidence disguised as logic. And then something changes. Not because the companies became bad, not because the economy collapsed overnight, but because expectations were too one-sided. And this is where people like Dave get punished, because the same behavior that made him feel smart starts producing the opposite result. High beta stops helping him. Momentum reverses. Risk shows up again, but this time it's real. Now here's the uncomfortable truth. Most investors don't lose money because they pick bad assets. They lose money because they misread the environment they're in. They think this is skill, when it was actually, this was conditions. And conditions always change. The market cycles between two states. One where risk gets rewarded and one where risk gets punished. The problem is they don't announce the switch. So people keep doing what worked recently because it feels rational. And that's the trap. There's a quote often attributed to investors like Warren Buffett that captures this idea well. What you learn from history is that people don't learn from history. And it sounds obvious until you watch it happen again in real time. So what's the point of all this? It's not that investing is impossible. It's not that markets are rigged. It's that most people confuse recent performance with long-term truth. And that leads to the same cycle every time. 1. Smart strategy underperforms. 2. Risky strategy outperforms. 3. Smart people abandon discipline. 4. Risk builds silently. 5. Reality resets everything. And when that reset happens, it doesn't matter how confident you were, it only matters how exposed you were. So next time you see someone outperforming the market consistently, the real question isn't, what are they doing right? It's, what risk are they taking that I'm not seeing yet? Because in markets, survival is not about being the smartest person in the room. It's about not misunderstanding the room you're in. And most people only learn that after the cycle changes.